Alrighty. So good evening and welcome everybody to the Easton Audit Committee meeting of Thursday, December 14th, 2023. This meeting will be conducted remotely over Zoom. Attendance by committee members will be remote and remote attendance shall count toward quorum. This meeting is being recorded by ECATS. Okay, so first item up on the agenda is the fiscal year 2022 audited financial statement and management letter review with Markham, who's our independent auditing firm. So Wendy, do you want me to hand it over to you for a quick introduction?
Okay, sure. So with us tonight is Scott McIntyre from Markham. Markham was formerly Melanson. And Scott has done the audit in the past, but this past audit was supervised by Ed Boyd, but Ed Boyd left Markham. And so Scott is here to present the financials tonight. And I can share my screen with the report if you would like.
If possible, Wendy, I think I would prefer to do it only because
sure.
Change the pages as I walk through the document. Rather than tell you what page to go to, I'll just do it myself.
That's fine.
Thank you. Yep. Good evening. As Wendy said, I'm Scott McIntyre, a partner with Markham. It's been a long time since I've been a little bit nervous doing an exit conference, but since I wasn't deeply involved in this engagement, I must admit I've gone through the document. I think I understand it very well, but maybe for the first time in a while, I have a feeling there may be some questions that I have to go look some things up on that I don't have intimate knowledge about. And if that's the case, I'll look them up and I will report back to the committee. Also, as Wendy pointed out, back in January of this calendar year, Melanson merged with Markham. You'll see it when I put up our independent audit as well. If you have the document, you see it on page 1 of the document. Essentially, there are so few students going into accounting right now that firms the size of Melanson, which is for a long time a large regional firm here in New England, we needed to avail ourselves of some additional resources. So we needed to make the move so that we can continue to provide services to cities, towns, school districts in the Commonwealth and in New England as a whole. So I can answer any questions that you may have on that. But without that, I'd like to just jump right into the results of the audit. Again, I'll share my screen in a few minutes. But as I saw Ed Boyd's notes from last year, they looked a little bit like mine from many, many years ago. We work closely together, and I respect Ed for deciding to move on from accounting as a whole. And he's going to go into a whole different industry. Anyway, what we have always done, and I think it's part of the most important communication the audit committee can receive from us, is just to let you know how the audit went. In our opinion, the audit went well. And what we really mean by that is that we found the books and records to be in good working order when we arrived to begin our field work. Cash, receivables, long-term debt, key accounts like that were reconciled on a regular and timely basis. And as a result, we didn't need to propose any significant audit entries in order for your financial statements to be materially fairly presented in accordance with generally accepted accounting principles. And if that sounds a little bit like required communication, it's because it is. Another piece of required communication is that there were no disagreements between the town of Easton and our firm on how to apply generally accepted accounting principles. And the last of the 3 significant areas of required communication deals with accounting estimates. There are several in your financial statements. The most significant are your net pension liability, your net OPEB liability, and the related deferrals. We'll probably talk a little bit about that tonight, at least touch upon them and what they mean. Also, the estimated useful lives of your capital assets is an estimate. The estimated allowance for uncollectibles would be uncollectible receivables is also an estimate. Those last 2, I don't want to say they're not significant, but they have less impact on the financial statements than the estimates of your net pension liability and those related deferrals. So that alone is probably the most important communication you're gonna hear from us tonight. I'm gonna jump right into the financial statements, and walk you through what I think are the highlights. It's my objective tonight to go through what I'm gonna call a medium length walkthrough of the financial statements. I'm not gonna try to do this in 5 minutes. Sometimes I'm asked to do it in 5 minutes. I'm going to walk through what I think is a comprehensive level here, but leave some plenty of time for Q&A at the end. So with that, I'm going to quickly share my screen, and I'm going to turn to page 1 of the document. And if by any chance somebody has a PDF on their computer, the difference between a print page and a PDF page is by a number of 3. So if I turn to print page 1, it's going to be PDF page 4. 3 years into it, I've learned that's an important part of this communication. So if you can give me a moment, I'm going to start sharing my screen.
Great. So while Scott's getting his screen up, Mark or Scott W., do either of you have any questions or comments before we begin?
I do not.
Okay. All right, great.
Great. So does
Sorry about that.
Okay.
I just want to make sure everybody sees the independent auditor's report.
Yep, we're
It says
seeing it.
Markham.
Looks like it's on your desktop. So we're seeing a Markham splash page.
Well, this one.
There we go.
Better. Yep.
You know what? 3 years in, I made a mistake. I moved it over so it was right in front of me, and it went to the wrong screen. I'll look over here. So, as we indicated back in January, we became part of Markham, which is a national CPA firm. Needed to avail ourselves of the resources that I spoke about. But really, there's nothing new here. This is our independent auditor's report. It is unofficially considered a clean opinion. Technically, it's called an unmodified opinion, which means that based on the auditing standards that we have followed, we followed 2 of the 3 sets that are out there. Only the 2, but the third one that we didn't follow is because it's not applicable to you. That would be the PCAOB standards for publicly traded companies. But we followed United States gas, or generally accepted auditing standards, as well as GAGAS, GAGAS, or generally accepted government auditing standards. I could speak about the difference between the 2 if you'd like, but really they're such similar. I mean, there's continuing education requirements that are different, but really those 2 standards are very, very similar. And as you see here, and I'm not going to walk through this in detail because there's nothing new here, but it is the highlight of the audit result. You come down, it starts with, in our opinion, your financial statements are materially fairly presented in accordance with generally accepted accounting principles. We list you our basis for our opinion, which is that we followed the applicable auditing standards. Tells you about management's responsibility for the financial statements, and then our responsibility of the audit of the financial statements. Again, there's nothing really new here, but it is a highlight of the audit. And again, in our opinion, based on the audit work that we've performed in accordance with the standards, in our opinion, your financial statements are materially fairly presented in accordance with GAAP here in the United States for governmental entities. Following that is your management's discussion and analysis, oftentimes referred to as MD&A. It's a great place to look at a later point in time to understand why key account balances have changed. But with that said, I want to pop all the way over to print page 12, which is PDF page 15. As I often say when walking through a set of governmental financial statements, there are really 2 sets of financial statements in this one document. I learned a long time ago, as often as I remember at least, to follow up. That doesn't mean there are 2 sets of books. It means there's 1 set of books. One basis is on a short-term perspective, or almost a cash basis. Technically, it's called the modified accrual basis. And what you see here in front of you on the screen is the long-term perspective. It's the town of Easton's, governmental activities and business type activities, which are presented on the accrual basis of accounting, the way a business would account for its activities and such. This page here lists the asset side of the equation. Right now, in terms of governmental finance, most of the talk about a long-term perspective set of financial statements for government is 1 more page down. It's on the liability side and the net position side. And I'm probably not gonna surprise anybody here if you've been on the committee. Most of the focus on long-term financial statements right now deals with those accounts right there. Your net pension liability and your net OPEB liability, OPEB of course being an acronym for other post-employment benefits. And when they say other, they're referring to things other than pension. And more specifically, they're referring to retiree health care. Now first, with the net pension liability, and for simplicity purposes, I'm gonna focus on the first column of numbers, which is your governmental activities. Just your governmental funds, your general fund, your special revenue funds, capital project funds, and permanent funds. The middle column of numbers here is your enterprise funds. We'll look at that stuff perhaps later on, but for simplicity purposes, I'm gonna focus with respect to the pension and OPEB liabilities as part of the governmental activities only. June 30, 2022, they're reporting a liability of $38.5 million. That number's down about $6 million over the prior year. Nice trend there, but hold on, because you may remember that this $38.5 million is your proportional share, that the town of Easton's proportional share of the overall Bristol County retirement system pension liability. And because this is in your June 30, 22 financial statements, this liability for the retirement system is actually measured or captured as of the end of the preceding calendar year. So it goes back to 12/31/21. And why I said hold on, because the liability went down and things may change going forward. Market values were pretty much, very stable and strong as of 12/31/21. When this liability, and it'll probably be published very, very soon if it hasn't come out earlier this week, when your proportional share of the county's 12/31/22 liability is determined, if it's consistent with so many of the others that I've seen, your liability in all likelihood will go back up to perhaps where it was at the beginning of fiscal year 22, maybe to the $46 million range. I don't have a crystal ball, but if Easton and Bristol County is consistent with everything else I've seen in the Commonwealth, I think it's fair to say that this number will go up from 38 million when your June 30, 23 financial statements are finally put together. The other thing that I want to point out about this liability is that it's measured with a discount rate, future earnings of the plan fund of a discount rate of 7.35%. It's actually down, a drop in the discount rate from the prior year. In the prior year, the county system used a 7.5% discount rate. And I know PERAC, the state oversight agency for retirement systems, has really been working hard to get retirement systems to lower their discount rate. 7.35, I think PERAC would tell the county, and probably has told the county, and by extension, contributing member units, that that's probably still a little bit high for their liking. At least through this measurement period, the system has had investment earnings that have been in excess of the planned discount rate. So kind of hard to knock the assumption when actual results have exceeded the estimate. But it is certainly something that I would suggest that the town of Easton continue to monitor going forward. Below that is your net OPEB liability with an account balance of $135 million. Again, that liability is as of 6/30/2022. As a point of reference, this liability has gone down significantly from the prior year. At June 30, 21, this liability wasn't 135 million, it was about 175 million. So it was nearly a $40 million drop in that liability. And there's really one substantial reason for that. While the town has a trust fund set up for OPEB, it's got a nice balance in it, but an actuary would tell you that it's not sufficient to pay current benefits. So as a result, the accounting standards make you default to a discount rate equivalent to a 20-year governmental bond fund, which as of 6/30/22, you were able to use a discount rate of 4.1%. June 30/21, when bond rates were down substantially, you had about a 2.2% discount rate. So discount rates almost doubled, not quite doubled, but almost doubled. And as that discount rate goes up, your liability is going to come down. And that's really what drove the liability down from 175 at the beginning of fiscal year 22 down to 135 million at year end. Now I mentioned when I was talking about significant estimates, I mentioned the pension liability and the OPEB liability, and I said the related deferrals. I don't usually talk about these account balances too much, but I'm going to touch upon them very quickly tonight because this is an important account balance right here. This deferred inflow of resources related to OPEB. Keeping in mind that I indicated that this liability right here of 135 million went down $40 million. What the deferrals indicate is that the deferrals are account balances that are set up to amortize changes in these liabilities over a systematic and rational period of time. So while your liability went down $40 million, and this is not an absolute, but it's kind of nice that they approximate each other. As this liability goes down $40 million, you see almost a $40 million increase in this related deferral for OPEB. So in other words, the benefit to your OPEB expense, the income statement portion of the long-term financial statements, essentially, the accounting standards don't allow you to benefit by reducing expense by $40 million all in 1 year. You have to amortize that in over somewhere between 5 and 7 years. I don't have that number right off the top of the head. It's in the back of your footnotes. But keep in mind that the majority of the benefit from the reduction in the liability, typically if the liability goes down, the expense will go down. With GASB 75, you essentially take about 20% of that benefit each year for a 5-year period. Again, that's not an absolute 5-year period. It's a fluctuating period, but for simplicity purposes in terms of the conversation, the liability goes down 40 million. You get about 20% of the benefit in that year. You get the other 80% of the benefit of that reduction in the liability by ultimately amortizing this 40 million down to zero over the next 5 or 6 years. I know I'm not being super precise with the number of years, but I'm simply trying to illustrate that this goes down 40 million. It doesn't mean your expense goes down 40 million. This goes up it went up by 40 million. In essence, you know, there's several different types of deferrals in there, and the benefit from the $40 million reduction is all because of the discount rate. There are some other key assumptions that would create part of these deferrals as well. So essentially, you get about 25% of the benefit of the retirement liability, the pension, the OPEB liability through expense, about 20% a year for 5 years. Sometimes it could be a little bit longer. I'll pause just in case I blundered that whole bit about between the liabilities and the related deferrals, and see if there are any questions on those two subject matters, those being pension and OPEB, and of course the related deferrals.
Just, I have a question. So that 39 million that we're looking at that's highlighted right now. So is that reflecting the remaining 80% of that amortized? So are we realizing the first 20% elsewhere? And then that's the remainder of it? Did I understand that correctly, or did I misunderstand that?
No, you again, it's a slightly more complicated.
Yeah.
I'll get into it in detail, but yes, I think you are understanding the subject matter very, very well.
Okay. All right. Okay. Scott or Mark, do you have any questions on that? Okay.
Oh, one thing I'd just like to add is that we did have the an updated actuarial valuation for 23. And the liability didn't really change significantly, which was good. So, and just looking at some of the notes. So one of the reasons that it didn't really change significantly was it said there was a reduction in the number of benefit eligible active employees, as well as higher than expected turnover during the 2-year period. So next year's results will look pretty much the same, or at least the liability will. I don't know about the deferred part, but
I suspect the deferred inflows of resources is probably going to be around $30 million. Just based on my experience, which means that the drop between 39, or I'll round up to 40, that's highlighted on the screen in my estimate of 30, that will reduce expenses in the governmental activities, not the general fund, the governmental activities, by about $10 million. All right, back to the long-term prospective financial statements. Really, so much of the conversation about any government's financial statements on the long-term perspective do deal with these accounts, the pension and OPEB. There are a wealth of footnotes on these subject matters. It is not my intention to go through them in detail. The key things to look at is, I've told you about the discount rates that are being used. I would urge you to take a look at what are known as the sensitivity analysis. In other words, if you had to drop your discount rate for pension from 735 to 635, that's going to significantly increase your liability. Those sensitivity analyses are designed to give the reader perspective of what would happen if there was a change in the discount rate. With that said, I'm going to hop all the way over to print page 15, which I think would be PDF page 18. And this gets us to what most people want to see in a local government's financial statement. In your case, obviously Easton's no different. People are generally going to focus on the governmental funds balance sheet, and they're going to focus on that first column of numbers, which is the general fund. Up here, we obviously have your cash and short-term investments, different types of receivables. I'll quickly point out this leases here. The lease, this is new to your financial statements here in FY 2022. Prior to this, or I should say effective with your 22 audit, you were required to implement a new GASB called GASB 87 on leases, all written up in your footnotes. Redefine the definition of a lease and what have you. And I will, as I scroll down to the fund balance section, which is the section that most people want to look at, I will also point out in the deferred inflows of resources, you've got some related to leases as well. So you've got the accounts receivable up here, and it's completely offset by a deferred inflow of resources. You don't capture it in revenues essentially until it's collected, both on the fund basis side and actually on the prior perspective, even on the accrual base side, you see an offsetting deferred inflow of resources to the receivable. Let's see, scrolling down to, this is what most people want to look at first, right here. They like to look at the total fund balance in the general fund. In your case, it was $15.7 million. A year ago, that account balance was about $13.4 million. So I'll flip forward in a couple of minutes to the statement of revenues and expenditures, and you'll see that the revenues and transfers in exceeded the expenditures and transfers out. So there's certainly the inflows of resources exceeded the outflows of resources. But sticking with the balance sheet for a minute, you have your unassigned fund balance. I've often said over my time that this is the first place that most readers want to turn to. They're going to skip over the pension liability and the OPEB liability until later on, but they're going to turn to the general fund balance sheet, and they're going to focus even not so much on total fund balance, but on the unassigned fund balance. And as of 6/30/22, you had an account balance of $10.2 million. It's down about $400,000 over the prior year. I don't think that's gonna surprise anybody on this committee. If you ask me, it was planned in fiscal year 22. There was a significant amount of free cash that was used, and that's all on purpose. We'll see that when we glance at the budget versus actual schedule, in a few minutes. But I always like to point out that in this unassigned fund balance number here, there's essentially two pieces to it. There's what I would call your true general fund piece, and then there's your general stabilization account. Under Massachusetts DOR regulations, Easton, like any town that has a general stabilization account, you account for it in the general ledger of the town as a fund that is separate and distinct from the general fund, consistent with what Massachusetts Department of Revenue requires. However, GAAP is a little bit different. Generally accepted accounting principles is a little bit different. Paraphrasing this a little bit, but you essentially can't take money out of the general fund, put it in the stabilization account, and not have it really be reported as part of your general fund. The revenues for that originated in the general fund, so that stabilization fund balance has to reside in the general fund. It doesn't meet the definition of a standalone fund, is what I'm trying to say. So this $10.2 million is really broken down between two pieces. Again, what I call the true general fund piece, and that's about $5.5 million. And the other piece is your general stabilization account, which as of 6/30/22 had a balance of about $4.7 million. So it's very important for the reader to understand that. There are footnotes in this document that fully outline the distinction of the two pieces of that $10.2 million that's highlighted on the screen. There's a significant fund balance footnote that would show that. And just by way of comparison, between 21 and 22, the general fund piece of the fund balance went down by about $1 million, and the stabilization piece of this number went up by about $1 million. Not surprising. You use some of your certified free cash to put money into your stabilization account. That's why you see what I call the true general fund piece coming down and the stabilization piece going up. And essentially, you will break even in this account. You had about a $400,000 change. And of the government the size of Easton, I'm calling 400,000 about a break even fiscal year.
Scott, and I just wanted to say too, and you know, you would see a transfer into stabilization every year because our financial policies are that we transfer 25% of our free cash certification into the stabilization fund, and we do that at the fall town meeting.
Boy, I think I remember that from about 5 years ago.
We've kept at it.
But quite honestly, I thank you for pointing that out, because quite honestly, I had forgotten. That's what I was afraid of, not having the super detailed, intimate knowledge here. But thanks for adding that in. It's a very important part of this conversation. Above that is the assigned fund balance of about $2.2 million. Can't quite highlight it there. That represents fiscal year 22 year-end encumbrances, unspent appropriations that will be honored in the new fiscal year, as well as some free cash that's been set aside prior to June 30, 22 that will be used in this case, the subsequent fiscal year or fiscal year 23. And above that is your committed fund balance. That is I believe that's your capital stabilization. I'm just glancing down. That's two things. That is about $2 million of that is your capital stabilization, because capital has a specific expenditure purpose associated with it. The accounting standards call that a committed fund balance, where your general stabilization doesn't have any expenditure purpose associated with it. That's why it's reported down here in unassigned. The other piece of your committed fund balance is some of your non-lapsing capital appropriations, appropriations that are accounted for in the general fund that have a multi-year life. Again,
right. And those would be any capital appropriations that we don't borrow for. So police cruisers, school technology, things like that.
Thank you. Last thing I want to point out on the balance sheet, and I'll hop over to the revenue and expenditure statement in a minute. You have two other major funds, the Community Preservation Fund and your capital project funds. Those are the same as they were in previous years. They're not always going to be that way. The accounting standards define very specifically what a major fund is. And in your case, because the assets of your community preservation fund are as substantial as they are, it meets the definition of a major fund, which means it just has its own column here on the face of the balance sheet and not part of this aggregate called non-major governmental funds. In your capital project funds, I don't remember, it's probably either the assets or the liability element that make it major. But again, because of the substantial activity that's in these two funds, they are required to and are presented separately, as I sometimes say, standalone funds, just like the general fund. I'm going to flip to 2 pages.
Oh, sorry. I just want to say too, the capital projects are particularly significant also because of the elementary school project for the Blanche Ames School, which was still in progress as of June 30th, 2022, but we opened the school last fiscal year in January of 2023.
And on the revenue and expenditure side, and keeping in tune with the capital project, and I'll talk about the general fund in a minute, but you see the capital project fund had a tremendous amount of activity on the statement of revenues and expenditures. 20 million in intergovernmental revenue, MSBA grants for school construction. You spent nearly $50 million during the fiscal year. You sold 44 million in bonds, got a $2.5 million premium. And there's some transfers in and out going on there, but the overall net impact is, you know, the inflows of resources exceeded the outflows by $17 million. Honestly, that $17 million number is not particularly meaningful because it's a capital project. It's not like you can say the fund had a surplus, operating surplus, not an operating fund. This $7.8 million is going to be some unspent bond proceeds that will be spent in fiscal year 23, perhaps even beyond that. So, coming back to the general fund for a minute, the focus typically is on both the third number up from the bottom, and as well as sometimes this number here, the 607. I like to point both of these out. This obviously drives the change in the total fund balance. This is where I said total fund balance went up by about 1.3 million. Most of this increase drove the change in your assigned fund balance and committed fund balance, not necessarily your unassigned. Because remember that dropped by about 400 grand. But a lot of people like to look at this number here as well. It's before transfers in and transfers out, and that's because credit rating agencies and financial institutions want to make sure that you're not relying on this number right here to turn this to a positive number. They don't like to see a negative number here turn positive by money being transferred in from another fund. In your case, you're positive here and you remain positive even after transferring in some money. Now you have some nice footnotes that disclose what this transfer in is. Pardon me, I need to just glance down very quickly unless Wendy, you recall what that is?
Yeah, it's a combination. So it's a combination of several things. So one of the amounts would be transfer from ARPA, use of ARPA funds. So we used some ARPA money for like the general revenue replacement. We were eligible to do that. So we used a portion, I think it was 750,000 for that year. And so that would be in there. We also have several like recurring transfers.
That's the key. A good portion of this $1.4 million is recurring transfer. It's a recurring from a recurring revenue source. You know, you transfer about 425,000 from Ames Trust, which is something.
Ames Trust. That's an annual transfer. It's usually in the area of 400,000. Sometimes it's 425, 435, but it's typically around that. We're an income beneficiary of several Ames trusts for schools and highways, and we never necessarily know every year what we're going to get. So, but because it is a recurring thing, we're able to forecast it when we do our budget and when we set our tax rate, we count that as a local receipt. But because it's going into a different fund and it's being transferred over, it shows up in the bottom line here instead. So yeah, that's around 400,000. We also have the septic loan program for people that had septic systems that were either in failure or to connect to sewer. They were able to do it through a betterment program that we offer. Those repayments go on your tax bill and they go into a different fund. And what we do is we transfer over the money from that fund to pay the debt service, because we run it through that program through the state's Clean Water Trust. It's a revolving loan program. So it's a lower interest rate loan program. They go out and do the bonding, and then we repay them with the proceeds from the betterments that we receive from taxpayers.
And excuse the interruption, but Wendy, Emily's in the participant queue, if
sorry.
you can
Thank
pull her
you.
over.
Thank
you.
For keeping track of that.
Yep, you're welcome.
On the transfers is you have a very robust transfer in and out footnote. It's on print page 52. I'm not necessarily going to turn there, but that will tell you and any financial institution or credit rating agency everything you want to know about these transfers. Really critical to understand the difference here and here. And essentially, what financial institutions want to know is if you're bringing in one-time revenue. And your footnote on page 52 clearly show you are not bringing in one-time revenue. With that, I want to hop over to your enterprise funds for a minute.
All right, and sorry, Scott, I don't mean to interrupt you, but you can still see the financials on the screen, right?
Yes.
Okay, good. Okay, sorry, in bringing Emily in, my screen looks a little bit different. So, okay, you can continue. Thank you.
On your enterprise funds, you have your water, sewer, and non-major. I'm here showing the statement of net position. It's otherwise referred to as a balance sheet, but technically it's called a statement of net position. I'm actually not going to talk about this page at all. And I'm also not going to talk about the operating statement, the statement of revenues and expenditures. Did a presentation not too long ago to the Mass Municipal Accountants and Auditors Association about understanding the statements. And with everything going on with capital assets and everything else, I have learned over time that the statement of net position and even the statement of revenues and expenditures of enterprise fund statements become a little muddy. I like to focus on the statement of cash flow. And honestly, this is what I think credit rating agencies and financial institutions focus on. As an example, we audited a couple of commercial airports, and again, the financial institutions, they don't really care about the statement in that position. What they care about are two things. It's one thing, but a combination of some numbers here. Net cash provided by operations. Does it cover principal payment on bonds? And does it cover your interest expense? That's the key metrics that most people want to look at when they look at a statement of cash flow. Does the net cash provided by operations, in your case, the $1.2 million, does it cover principal payment on bonds of $250,000 and interest of $179,000? In your case, it clearly does. That's what's allowing the fund. In addition, you have some borrowing that went on during the year, but you're also very likely using some of that net cash that's provided from operations that is not used for P&I on long-term debt, using your own cash for the acquisition of capital assets during the year. That's the relationship that most people like to focus on when they look at their enterprise funds. If you look at your sewer fund, and I remember this from a few years ago, it's still a very new fund. It's not necessarily at the same level that your water fund is yet. And in fact, this is a key number on your statement of cash flows for your sewer fund. Your net cash provided by operations is negative. And of course, as a result, it's not going to be covering P&I. you need this transfer in from, I believe it's from the general fund. Randy, jump in if I'm wrong about that.
No, I think that might actually be, betterment payments, because we have a mix of betterment payments with the sewer fund. So we have 3 sewer districts, and the first 2 districts were authorized before the change with the Municipal Modernization Act that required you to put the betterment repayments, you had to put them in a receipts reserve for appropriation. So those are, I believe, betterment payments that are just coming through the sewer fund.
Okay. But again, those would be for principal and interest, in all likelihood, principal and interest. It certainly has to be accounted for and reported differently. But in terms of that nice relationship that I think most readers like to get at, you'd have to do a little bit more digging in your case with your super. That's why I like to focus on the statement of cash flows for enterprise funds. And lastly, I'm going to flip forward 2 more pages. I'm going to skip over the statement of net position of your OPEB fund and simply go down to statement of revenues and expenditures. As I said earlier, you do have a trust fund set up for OPEB benefits. It has a couple $100,000 in there. It's great, and I'm not being critical of this, but it's not going to cover the liabilities at this point in time. That's why when we talked about the discount rate that you're using, the accounting standards make you default to about a 20-year general obligation government bond fund. Whatever the discount, whatever the interest rate is on that, you would get to use that as your discount rate. You see the difference between the employer contribution of 3.991 and the benefits that were paid of 3,966, a difference of about exactly $25,000. That's the contribution that the town made into the benefit trust fund during fiscal year 22. The benefits that are paid of 3.9, that's an implicitly determined number. That's what your actuary has determined, that out of essentially the appropriation for health insurance, this $4 million is essentially is the implicit subsidy of the retirees who are pooled with the active employees. This is what it's costing the town essentially on an annual basis to have those retirees pooled with your current members. Easton's no different than basically every other community in the Commonwealth. So, beyond this page, there are a wealth of footnotes. I'm going to stop sharing just for a minute. I can always go back. Beyond this page, there are a wealth of footnotes on your long-term debt. I've sometimes do go to those. A key metrics that I've often pointed out that people like to look at is how rapidly you're paying off your debt. Easton has historically been one that pays pretty rapidly. As we pointed out back when we saw you sold bonds of 44 million. When you sell bonds of 44 million this year and you're paying for them over, I think it's 25 years, all of a sudden that nice relationship that looks like you're paying your bonds off rather rapidly, it's skewed a little bit right now given the newness of that debt. But in return, obviously I know Wendy informed me what else is going on in the community, so it might be a little bit longer before it returns to its normal repayment schedule.
Yeah. I also just wanted to point out too, because usually when you issue debt like that, you issue level debt. So typically your municipal debt, it's equal principal, which means that over time your interest declines. Whereas level debt's going to be more like when you pay your mortgage. So that means that less principal is going to get paid early on, but it stabilizes your payments, and keeps them more level over time. Otherwise you'd have a huge payment, probably the first like half of the life of the bond issue. So I just wanted to point that out.
There was another page I was going to share. Perhaps I stopped sharing too quickly. It's print page 72. It's your budget versus actual page. I can go back to sharing, but essentially the focus there. Why don't I go back to sharing?
Yeah.
And take some questions. Wendy, is that back on the screen?
Looks good.
June 30, 22, budget and actual comparative schedule. You have an original budget, the final budget, the actual amounts on the budgetary basis, and then you have your positive and negative variances. On the revenue side, about $2.3 million better than you expected. This 2.3 million is about 2 times the favorable variance that it was in the prior year, and most of it deals with this number here, the 640,000 in favorable excise revenue. That number is about double from the prior year, as well as your licenses and permit. This favorable variance is about 3 times what it was in the prior year as well. So some strong revenue performance right here. And on the other side of the equation, on the expenditure side of the equation, almost 600,000 in unspent appropriations. In other words, the expenditures and encumbrances were less than the 87.4 million that was appropriated for town departments. Sometimes that number is referred to as expenditure turnbacks, unused or expended appropriations. Combination of the revenues and expenditures give a positive budgetary results for the year of about 2.9 million. And then this lower section here sometimes gets a little confusing. Let me try to explain what's going on. Of course, you have transfers in and transfers out, and you almost always have some small budget to actual variances with those. But then you come down to this section here where you have some big negatives. It shouldn't necessarily be seen as negative, but it's the presentation here is by design. Clearly, the budget called for the use of fund balance of for operating purposes 944 grand, for capital purposes 1.2 million. There's the $1.2 million that went into stabilization, and the 320 was for probably a variety of other things. I don't have that at my fingertips. And when you use your certified free cash, you are expecting the outflows of resources to exceed the inflows of resources. So when you expect the outflows to exceed the inflows, it's going to have a negative effect on the bottom line. So coming back to the variance column here, the combination of the revenues and expenditures was a positive $2.9 million. But when you soften those results by the amount of free cash that was used during the year, essentially it's this $3.4 million number right here. You come down to, in the lower right-hand corner of your budget versus actual page, it's in parentheses indicating that the outflows of resources exceeded the inflows of about $579,000, a reduction in $579,000. And it's this number here that, going all the way back to when we were talking about the general fund unassigned fund balance, that first place that most readers like to turn to, we indicated that key number went down by about 400,000. It's this 579 that's driving that $400,000 reduction in your unassigned fund balance. Clearly, they do not work mathematically. They're not designed to work exactly mathematically. But once in my 36 years of doing this, have I seen it work exactly? That's when somebody never encumbers any money in either fiscal year. It can work out that way. But Easton, like 99% of our clients, have year-end encumbrances and carry forwards, which are really just timing differences between when the money is actually spent and when it's considered expenditures expended for budgetary purposes. So again, 2.9 million budgetary results, very strong operating results for fiscal year 22, softened by the use of free cash. And again, some of that free cash was just put in a savings account, your general stabilization account.
Right.
Well, results were negative $580,000, and it's this 580 that is driving the reduction in unassigned fund balance back on your general fund balance sheet.
Yeah, and Scott too, I just wanted to also point out that the variances, particularly on the revenue side, that was really a combined effort, town and school, in setting the budget, because if you compare the actuals for some of like the local receipts, they're really they haven't improved as much as you would think by looking at the budget versus actual. It's just we were all really conservative in doing our estimates, so that we could generate that free cash and not not inflate the budget too much.
Wise. let me stop sharing for a minute. I'll pause. And I went through it, like I said, in a medium length detail. Hopefully somebody didn't think it was too long, but I wanted to give you the high points and give you a comprehensive walkthrough. Let me pause and see if I can try to answer any questions that the committee may have.
Great. Thank you so much for that presentation. So committee members, any questions, comments, Scott? And I believe, Emily, is this your first time going through the full audit presentation as well? Oh, we're not picking up your audio.
Can you hear me now?
Yes.
Okay. It looks like it's going. Yeah, I'm so sorry I was late. This is super interesting to me because I'm in the world of like corporate accounting finance. So very cool to see like how it works for governments and stuff like that. But yeah, it is my first time. So I apologize that I was late there, but super interesting.
Oh, all right. Yeah, so I know Mark and I have gone through the presentations before, but so certainly questions from anybody, but Scott or Emily, if you have any questions that may even seem like, to take a step back and kind of orient yourselves to some of the accounting principles or whatever, which may be different than what you're familiar with if you're coming from, the private sector or corporate finance, feel free to ask away. I'm sure Scott will be happy to answer anything that you need.
I'm just curious, when we do form the budget for Easton, like, it sounded like you're obviously going to want to come in under budget or like perform better. So like, it's probably like, not that you would ever sandbag the budget by any means, but like, that's kind of the approach of like how conservative versus optimistic versus like right on the nose you want to be. You like have some sort of buffer in it. Is that the strategy?
Right. Yeah. Because I mean, you want to be able to generate a certain amount of free cash every year, because Easton is in a position where we need to balance the budget with free cash. And it kind of comes down to how much every year. It's really a balancing act. We set the budget, we start out we're very revenue driven. So we look at, how much revenue do we think we're going to have available? We try not to push those revenue estimates too high, because if we do, we're going to end up in a situation where we have like no free cash the next year. So, and again, it's a balancing act, right? Because every year you have different needs. You have your budget needs, you have your fixed costs, and you have to weigh that against what services are you going to provide and which ones you want to keep and prioritize.
That makes sense.
Yeah, I can say on the school side, we intend to spend every penny we're allocated because we need it, right? So yeah, we're not estimating high on anything. There have been turnbacks historically, and especially in recent years with COVID disrupting a lot of the services. So a few years ago, for example, our transportation costs were slashed dramatically in the middle of the year. Whether or not we're getting free school lunch was a question for a couple of years. Now it is free. So there were some things that we haven't been able to hire enough subs necessarily to spend our substitute budget, which is not something we want. We would rather spend that. So so sometimes it's what you're seeing when there are turnbacks is just a function of other constraints not allowing you to spend the budget, which is not optimal because you're not providing the services that you need to provide either.
But also too, the last couple of years, we've been fortunate, like a lot of communities have been fortunate. There's been a lot of federal grant funding too, that also allowed you to sort of save money in those areas. So, but that, obviously we're not expecting that that's going to continue.
Yeah. And I just want to point out as well, so when we allocate the money, the money's allocated every single year for all the departments. And, in at the Springtown meeting, it's released July 1st. You can't overspend. You can't go over that. So and it's impossible. Like if I were to go to the grocery, if you go to the grocery store and I say spend $100, not a penny more, the chances of you spending exactly 100 are very small. It's going to be $97 or $96 because legally you're not authorized to go over that. If for some reason you did, then you have to dip into free cash to cover things. So the town every year spends, like a 97% or 98% of the allocated budget. So that remaining percent is what, and I'm so sorry to jump in and do this, but so that remaining percent is what's free cash. So what do you do with it? You put it back, and you want to just keep accruing that every year. And from this presentation, we've done that. We've done that exceptionally well over these past 5, 6, 7 years. And I actually, I think if you were to take OPEB out of everything, every year that goes by, we're doing a little bit better, which is amazing given what we've come through.
Seriously.
Yeah. I feel like that's my 2 cents.
I think it's really helpful context, Mark.
Yeah, thank you. I have one other, I guess, 2 questions on like the sources of cash side and like debt in general. I know so like at my company, we've got like a revolver and like term debt. How do we handle like timing differences, and do we have any kind of like lines of credit that we use, or is it all like term debt? And then also, is there any kind of like covenants or like ratios we have to maintain at any given time with like liquidity?
Almost all of your debt, I think all of your debt is term debt. You've not issued any revolving line of credit, at least that I'm aware of in the last several years. Your quarterly billing, you bill and collect your taxes on a quarterly basis. That's something that's been done in Easton for, I'd say, many years now, and it's pretty much in the Commonwealth. Way back in the old days when I first started doing this, towns were billing and collecting only semi-annually. That required towns to go out and get tax anticipation notes. Those are seen as a credit negative. If you have to borrow anticipation of your taxes, banks don't like that, although they like loan you the money.
Yeah, we've never had to take those out. The other thing too that's helped though over the years is that our state aid distributions, at one point they used to be quarterly. Now they come in monthly. So that also helps with the cash flow. And the debt that we have it's mostly, we issue bonds, and then we issue debt through the Clean Water Trust. So in terms of like revolving or lines of credit, maybe you could count the Clean Water Trust. Before you go permanent with your financing with a Clean Water Trust, they give us what they call an interim loan note. We basically draw off of that. And then, after, it's usually like around a 2-year period. And it's a good financing mechanism because we don't pay any interest on that. Whereas if we issued a bond anticipation note, we're going to pay interest on that. So it's not until they go out and they do their borrowing that then we start having to pay back principal and interest, and then it becomes permanent.
And Emily, I think there was a second part to your question. Can you just maybe repeat it?
Oh, yeah, just here. I'm in covenant land right now with my company, making sure we're not going to trip anything next year with like FCCR, fixed charge coverage ratios. Just curious if we like have anything like that we have to keep in mind.
No, in the governmental world, that usually comes into play when governments issue revenue debt very, very infrequently with cities and towns, absent Boston in the Commonwealth of Massachusetts. Places like the MWRA will issue revenue debt, and they have rate covenants, and some of the airports that we're involved with. And it goes back to that statement of cash flows where I was saying the key relationship are there net revenues to cover P&I?
Mm-hmm.
Most common rate covenant, again, this is not applicable to Easton and almost every single city and town in the Commonwealth, but the most common rate covenant that we do see in enterprise fund accounting is that the net revenues have to equal 125% of P&I.
Got it. Thank you so much. This was really helpful. I really appreciate the context.
I haven't with, and I know Emily came on a little bit late. Wendy indicated that I was the partner on the job for many years, and then I handed off to at this point in time, I have to call my former partner, Ed, who decided to leave and go into a different line of work. Not looking for sympathy, but I've been a little bit backed up with him leaving. In terms of a management letter, a lot of the things that we talked about in the prior year, where there were, ironing out some year-end timing issues, ambulance receivables, and getting ready for some new GASBs. As I indicated, those are some things that the town needs to continue to just perfect a little bit, not major issues. The new GASBs, for this fiscal year 22, it was GASB 87 on leases. For fiscal year 23, it's 2 new GASBs, GASB statement 94 and 96. Very much related to the leases. My own personal opinion is when GASB or the standard setters, when they wrote the lease standard, they said, we're going to exclude subscription-based arrangements. And then I think they, my opinion, and then I think they said, I think we missed the boat. So they wrote a new standard, GASB 96. And essentially what you do with your leases now, under 87, now you have to capture subscription-based information technology arrangements and bring them onto the books. GASB 94 deals with PPPs or public-private partnerships. If you have any in the town of Easton, need to be reflected in your 23 statements. The other thing, and Wendy and I quickly talked about it the other day, in terms of, you know, things like compensated absences and things like that. Anything that can be done, the town closes its general ledger in a very timely manner. Sometimes it's the things that are external to the actual general ledger that are required to be counted.
Yeah.
By, what's that?
Yeah, no, I agree. I totally agree.
The general ledger that aren't part of the uniform municipal accounting system that the Commonwealth of Mass prescribes. But all of those things are important to the outside audit. So getting the timeliness of compensated absences and leases and speed is of the subscription-based information technology. The timeliness of all that stuff
Fixed assets.
Fixed assets, thank you.
Fixed assets really the thing that really does it for me. We are getting better. I'm having my assistant do more of that for me. And Linda Hawks, treasurer, she took on the whole OPEB thing, and I mean that's already done. So we don't have to worry about getting that done. The thing that's really difficult is, you know, our staff. Easton does a great job with a lot of things, but our staffing's always, you know, really been lean. And if the audit, if all the stuff that the auditors need doesn't get done by the end of December, it just stretches the audit out because it's so hard to get back to it because we're in the middle of budgets, and budgets will just take up like all of my time, and then some. Because, you know, you still have the regular day-to-day stuff too. So that's sort of what drags this out. But I feel like we're doing better on that. And which is another reason why the last time we had a meeting, we were looking at doing, you know, like a 1 year and then going out for quotes. There's just really been like no time for that. And now we're already, you know, in December. And at this point, I mean, it would be my request that we do another annual contract with Melanson so that we can get that audit going. In particular, because now we've got this, you know, public safety, public works project. Getting the audit done and those financial statements out is going to be very critical in the next coming years. So that would be my request.
And the upcoming projects that Wendy talked about, that's really why I bring up things like the compensated absences and the capital assets, because it just sensed there's going to be a real need for more timely publication of this report.
Mm-hmm.
All right.
Yeah, that's not the longest walkthrough of financial statements I've ever. Give you a pretty good sense of the audit process, on how the audit went, and give you a comprehensive walkthrough of your financial statements. They're yours, they're not ours. They're your financial statements. So I wanted to give you a somewhat robust walkthrough. So, but I'll try to answer any other questions that the committee may have.
Okay. So let's see. While I had something I had flagged earlier. Maybe I think it's more of a question actually for Wendy. So you know what, it's not jumping out at me. I can follow up with you. It was just something, it was one of the education items jumped out at me as having kind of a
Oh,
substantial year
was it
over
the
year.
total- Oh, year over year? Oh, I wasn't sure if
Yeah,
you were
I think it
talking
was,
about the education spending in the general fund, because that gets increased for the state's contribution to Mass Teachers Retirement.
okay. Oh, yeah, actually, yeah. So my
Gross that
question
up.
is, it's on page 8 printed out. The education line item. So this is the changes in net position. So education went from 77 million to 65 million year over year.
I'm gonna have to look most of that up. I would tell you that I think probably half of it deals with, we have to go back to the conversation of the reduction in OPEB liability.
Okay. Okay.
And obviously, the whole reduction, as I indicated earlier, does not have an impact on expense in the current period. But I strongly suspect, and I can look this up, I don't have it at my fingertips.
Mhm.
Right, it would take me 10 minutes to look up the answer, and I don't think you want me to do that.
No.
I suspect that somewhere between $2 and $3 million of this reduction is because on the accrual basis of accounting, your OPEB expense came down.
Okay.
Yeah, I'm not a fan of those statements, just because I feel like they throw everything in the kitchen sink in there. You know, and get depreciation of assets. And even, you know, we talk to Moody's and we have our ratings call. Like, we never talk about those statements. We always go to the fund financials, where you look at the general fund balance.
Mm-hmm. Okay. I think that was the only thing that I had noted that you didn't address in your walkthrough. I'm just checking because I have to present to the select board next week. So I'm just looking at my notes from prior year to see if there were any other topics that we see. So we covered pensions, unassigned balances. Something that's been, and I think the new debt for the school will factor into this part of the conversation. But we had talked about the AAA benchmark for the percentage of debt to be paid back in 10 years is 75%, and that we were at 86% in the general fund debt to be on that schedule. I didn't make my way through all of the notes. Is any of that summarized in the notes here, just so that I can address that if it comes up in our conversation next week?
You don't see the percentages in there, but if you go to print page 46,
Mm-hmm.
towards the bottom, and I'll take a quick moment here and reshare my screen. You should see the bottom of page 46 down here.
Yep.
You have some general obligation bonds, and you have some direct borrowings, and then you have your total.
Mm-hmm.
And the metrics that you mentioned, and I often mention it too, and I'm not doing a nice job highlighting things here, but it's this, the first 10 years of principal payments.
Mm-hmm.
0.6 all the way down, and then this 5-year period from FY28 to FY32.
Okay. All right, so I can do the math on that. Yeah. Okay.
Again, it's skewed. It's on the surface, the percentage is going to be substantially different. I think you mentioned, did you say almost like 80-something%?
It was for fiscal year 21, it was 86% of the general fund debt and 68% of business activity debt, such as water and sewer, were scheduled for 10 years. And I think that was 52% the prior year. So I think something substantial had rolled off. Wendy, did we retire? Was that maybe one of the old debt exclusion override balances. Did RO get paid off, or middle school, high school?
I feel like that's been paid off. The middle school and high school are going to get paid off in, I think, like 26 and 27.
Okay. Yep.
When you do the math,
We
you'll
probably
50% over a 10-year period. So it's significantly different. It's very much different because of the current year issue of $44 million.
Yep. Okay.
right. And I do feel, because that's exempt debt, it's not non-exempt debt, so we don't have to fit that in the operating budget. That's viewed a lot differently, by rating agencies.
Okay. Great. Thank you for that. Let's see, just seeing what else we had for OPEB. We had a lot of notes on that. And again, we talked about, yes, we talked about how, we're using the 20-year municipal bond rate index, which we already talked about. Do we know, is the funded status in the notes here of the pension?
Yes, it is.
Okay, I can find it then.
Technically it's in the RSI, or required supplementary information. You would see it on print page 74, and it's just under 72%.
Okay.
Keep in
I
mind,
feel like it's been hovering at that for a number of years. I think one of the things that I think the county retirement, all retirement systems face is because municipal pensions are they're salary based, and salaries go up. You sort of have this moving target over time. You fund the liability, but then if you have a lot of salaries go up and people retire, then that's going to increase your liability also.
Yeah, and then you have the rate movements and market movements and all of that. So yeah,
Right.
That's my day job. So we see funded status calcs all over the place. It does look like that 71.6 is a jump from 2021 was 65, 2020 was 61. So that is a nice movement. But again, like I've seen, that's a lot based on rates.
measured as of 12/31/21. Think of where market returns were as of then,
Yep.
compared to 12/31/22.
Yep.
The crystal ball, I know I'm kind of disclaiming this here, but I would be surprised if that funding percentage doesn't drop back down
Into the 60s. Yeah. Okay. Yeah. The MTRS one was a huge jump as well. Is that also as of 12/31/21?
No, that is as of 6/30/21.
Okay. Oh. All right.
You see that also on page 74.
Yeah. Yep. I see that. Wow. Do you know why they're a year off?
Well, I do. The answer to that is really no different than why Bristol County is 6 months off. Bristol County retirement system operates on a 12/31 on a calendar year end. So they measure their liability at the end of their fiscal year.
Mm-hmm.
MTRS operates under a fiscal year period, and the accounting standards, and we're all grateful that they permit this, they allow you to use a measurement date which is different than your fiscal year. And I say we all like this because if MTRS had to complete its June 30, 2022 audit, actuarial valuation, and what we call an AU 805 and AU audit standard section 805, and allocate that liability to all the members, they get that report done about 10 months after year end. I mean, you get 10 months after year end.
Yep.
So thankfully, the standards permit what we call a prior year measurement date to be used.
Okay. Thank you.
Practical.
Yep.
Right. That's stated more simply than I said, Wendy.
Okay. All right. Do any other committee members have any questions or comments?
No, I found it very, very informative, actually. And I'm glad to be here and see how this operates and all. So I appreciate it. Thank you.
All right, then I think we can then let Scott McIntyre go, and we have a couple of other things on the agenda to let's see. So we're going to vote on a couple of items coming up on the agenda.
Thank you very much for your time, and have a nice evening.
Great, thank you.
Sorry.
Okay. Great. All right. Well, thank you, everybody. That was a good discussion. All right. So next item on the agenda is the audit contract for the fiscal year 2023 audit. So discussion and vote on a recommendation that we can make to the select board. So Wendy, I know you spoke to this a little bit. So if you want to give a little bit more detail to the rest of the team, and we can take a vote.
Yes, great. Thank you. Yes. So typically we will do like a 3-year audit contract, but again, last year we did a 1-year. It was at the end. The time just really flew by this year. So I'd like to do another 1-year contract with Melanson, Markham now, and even for possibly like next year, because I don't. The next year's audit is really to get the 3-year quotes. We would have to do that this spring, and that's coming fast and furious. Okay. So my recommendation would be we'll do the 1 year for now, but I would like to do another 1 year later on with Markham. The prices that we got this year. So currently the audit fee is $47,000. It's a breakdown of $37,500 for the financials, $3,500 for the single audit, and $6,000 for the school end of year report. And so that was a total of $47,000. They're proposing an increase of $2,000 to $49,000, and that's in the financial statement area. So $37,500 to $39,500. This year also, every few years we have to do an audit of student activity funds, and that is going to be due this year as well. They're proposing $8,000 for that. Typically, I think that's around like $6,000. So, but you know, as we've seen, everything is going up.
Okay. All right, so it's about a 5% increase on the main audit.
Mm-hmm.
Okay, but they would keep the single and the annual school the same?
Yes.
The 3.5 and 6. Okay, but we've got that student activity one.
All right.
Okay, so student activity, that's a pretty substantial increase, but that's over what we got for pricing for 3 years ago, right? It's every 3 year.
Right. It's been like $6,000 for a while, so it's been flat for quite a few years.
Okay, all right. Okay. I mean, I deal with Markham professionally. I know they're a large, well-established, well-regarded audit firm. And the explanation for why Melanson had to merge made perfect sense. We're actually, when my clients go through their audits, we're seeing a lot of, I think, 22-year-olds who are just starting out. So there's a lot of staffing issues, I think, with audit firms across the board. So I'm definitely seeing that professionally, as well as what they reflected here. So I'm comfortable with the 1 year. Mark, if you think the select board will be comfortable with that recommendation.
Yes, I do think they will be comfortable with that recommendation.
Okay. All right. Would there be a reason to not recommend 2 years right from the get-go and save the kind of administrative headache of voting for a second 1 year contract, and then we can focus on going out to RFP for a 3 year at the appropriate time?
I didn't get pricing for 2 years, so I just got the 1 year. I mean, I could add, when we do the presentation for the audit, we're not gonna, we can mention the audit contract, but that would come up at a meeting in January when we have all the documentation, we have an engagement letter and all of that, we get all the contract paperwork put together and signed. So that would come later. So
Yeah, I would think it'd be worth it to ask for 2 year and see if that can maybe discount a little bit. Maybe we could get a slight reduction on that 8K amount or something, there could be, or at least maybe lock in the same price for 2 years for the main components, or see if there is any possible gain from locking in for 2 years.
Okay.
I think it can't hurt to ask.
Yeah, for sure.
Okay. Okay. Alrighty then. Does anybody else have any questions or comments on that? Otherwise, we can move it ahead for a vote. Okay. So, because this is a remote meeting, all votes are by roll call. So I'll just call your name and you can just say yes or no. Okay.
You need a motion
so I'm going to make a
first.
motion.
All
Yep.
right.
So I'm going to, so can somebody make a motion then to vote for the recommendation to continue the Markham contract for 1 to 2 years to the select board?
So moved, Lamb.
Okay. And can I get a second on that?
Okay.
Great. Alrighty. And roll call vote. So Lamb?
Lamb, yes.
Weiss?
Weiss, yes.
And Woodward?
Yes.
And
Woodward.
Star, yes. Okay. All right. Great. And then next up is acceptance of the 10/6/2022 minutes, which were super brief. Let me get back to that. Yes. So Emily and Scott, just for some background information, we can't publish the minutes of our meetings until we have a meeting to vote on the minutes for the meeting. So we'll talk to Roseanne, who is listening to the meeting, and we'll do our minutes, find out a reasonable time when she thinks she can present the minutes for this meeting. We'll schedule a subsequent meeting to approve those, and that way they can be posted to the website so that they're available to the general public and they're not waiting, months and months and months for us to meet again. So most boards and committees meet frequently enough that you just take care of them in the normal course of business, but where our meetings are fairly infrequent, we try to get those out so that the public can see them as soon as possible. Okay, so the minutes, let's see. They were sent around by Wendy. And so does anybody have any questions or comments? They're very straightforward.
Nope. I'll make a motion to approve those minutes as is.
Okay. Somebody second?
Second.
Right. And roll call vote. Lamb?
Lamb, yes.
Weiss?
Weiss, yes.
Woodward?
Woodward, yes.
And Star, yes. Okay. All right, great. So I don't want to put Roseanne on the spot, but if she wants to maybe either come off, participate or participate through chat and give us an idea of when it would be reasonable to have the minutes so that we could schedule something. It'd be great to maybe schedule a subsequent meeting since we're all on the call right now and can look at our calendars.
Can you hear me now? Sorry.
We can. How are you?
Hello.
Hi. All right. So what would be a reasonable time frame for us to get back together so that we can review minutes?
Right. I mean, I always try to type them up as I go every time. When do you think I can probably get them done. I just have to watch the recording in a couple of spots. Okay. But within I would say a week or two, if that works for you guys.
Okay. Do we want to maybe shoot for a month out? I think that would, yeah, because we get the holidays and it's not a super rush.
Right. Yeah, no, you're right. I know, how could I forget that? Right.
Okay. And does anybody have the ability, do evenings work best, or does anybody have the ability to meet during the day via Zoom? Because this can be, I think we had our last one at 9:30 in the morning and we were done by 9:38. So it's literally a 5 or 10 minute meeting.
Yeah.
Yeah, I'm good. I can get. What's
Okay.
quorum? How many people do we even need for quorum? 3?
3. Yes.
I can do
Yes.
it.
Okay, and I'm seeing Emily and
Yeah,
Scott also nodding.
I can make days work. Yeah.
Okay. Okay, great. So let's see, Wendy, looking at, I don't know, maybe the week of the 15th in January. Is there a day that works well?
Is that Martin Luther King?
That is Martin
That
Luther King Day. Yep. Yeah, so that
Well, I mean,
week.
we usually do like, well, actually today's Thursday, but I mean, I don't really care what day we do it. I mean, in the past, we've done like Tuesdays and Wednesdays, although I feel like in the past, we used to do that just because it was easier to get meeting space when we were meeting in person.
Mm.
So, but that week, I am, yeah, I'm pretty open that week.
Okay. Would like 9 a.m. on Tuesday the 16th work for everybody, or like 9:15?
That's fine with me.
Yeah.
Yeah.
Yeah, that'll
Okay.
be fine.
Okay. All right. Let's lock that in then for 9 a.m. on Tuesday the 16th. Okay. Let's see. All right, so Wendy will get that scheduled with the town and get the Zoom link and agenda out. Roseanne will provide the minutes. I will be presenting a summary to the select board on Monday night. So tune in for must-see TV if you'd if you'd like. I think you guys probably have a bit of a long night ahead of you, right, on Monday, because we've got the
Yes.
school committee appointment
With
as well,
that,
which will
and
take a while.
our agenda is probably like 2.5 pages. It's a huge agenda, so
Wow.
bring your popcorn.
Okay, well, I'll try to keep the presentation as robust, but condensed, short. Yeah, we'll keep it high level. Okay. All right. Does anybody else have anything you want to mention before we adjourn?
Thank
Okay.
you
Well,
all.
thank you all. It's been great. It's nice to meet you. And thank you for joining tonight. Hopefully it was a good learning experience for everybody. And we'll get together in January. So happy holidays to anybody I won't see in between. All right. Can I get a motion to adjourn?
So moved.
And okay, roll call vote. Do we have to roll call that? Yeah.
Lamb, yes.
Okay. Weiss?
Weiss, yes.
Woodward?
Woodward, yes.
Star, yes. All right. Great. Thanks, everybody.
Thank
you.
Have a good night.
Good evening, everyone.
Bye.
Night.